Imagine waking up one morning and realizing the rules of the global economy changed overnight, not gradually, not predictably, but instantly. No warning bell, no adjustment period. Just a sharp jolt that ripples through markets, boardrooms, and kitchen tables alike. That's the moment we're living in right now. And if you think this is just another headline, another policy debate that won't touch your life, stay with me because what's unfolding goes far deeper than tariffs, politics, or short-term market moves. For weeks now, something unusual has been happening beneath the surface. Markets haven't been panicking, they've been hesitating. And hesitation in finance is far more dangerous than fear. Fear creates motion. Hesitation freezes capital. It delays decisions. It rewrites plans. And when trillions of dollars pause at the same time, the consequences are not loud. They are slow, quiet, and powerful. This isn't about ideology. This isn't about left or right. This is about how fragile confidence can be when policy uncertainty enters the system. One announcement can alter supply chains built over decades. One shift can force companies to rethink investments that were supposed to last a generation. And once uncertainty takes hold, it doesn't leave easily. What you're seeing in the markets right now is not chaos, it's calculation. Investors are recalibrating. Businesses are reassessing. Global partners are watching closely. Everyone is asking the same question, silently but urgently. Can we still plan for the future the way we used to? Because when planning becomes difficult, growth becomes optional. And when growth becomes optional, economies don't collapse. They underperform quietly, persistently, almost invisibly. Until one day, the gap between what could have been and what is becomes impossible to ignore. So if you want to understand why these weeks have felt different, why confidence feels thinner, why markets move not with panic, but with restraint, then stay with me. Because this story isn't about what just happened. It's about what happens next. Markets don't fear bad news. Markets fear uncertainty. And over the last several weeks, uncertainty hasn't whispered. It has spoken loudly, decisively, and repeatedly. Policy decisions around tariffs have injected a level of unpredictability that even the most experienced investors have had to pause and reassess. When rules change mid-game, capital hesitates. And when capital hesitates, the entire economic engine feels the drag. Tariffs, by their nature, are blunt instruments. They are not surgical tools designed for precision. They apply pressure broadly, often indiscriminately. In recent weeks, that pressure has shown up in places that matter deeply. Pricing models no longer hold. Supply chains that took decades to optimize are suddenly under stress, and forecasts that once carried confidence now carry footnotes. For investors who rely on fundamentals, earnings visibility, cost stability, long-term growth assumptions, this environment has been challenging, not because opportunity disappears, but because clarity does. The market thrives on signals. Clear policy signals allow businesses to plan, invest, hire, and expand. When those signals become erratic, markets respond the only way they can with volatility. We've seen sharp movements, not because companies forgot how to operate, but because the framework they operate within has become less predictable. And unpredictability forces risk premiums higher. Capital becomes more selective. Liquidity tightens. That is not ideology, that is market mechanics. What makes these weeks particularly difficult is the compression of decision-making time. Executives are being asked to make long-term commitments, factories, logistics, workforce investments, while policy horizons feel increasingly short-term. That mismatch creates hesitation. And hesitation, multiplied across thousands of companies, becomes an economic headwind. It's not dramatic, but it's powerful. It shows up slowly, then all at once. Investors are adaptable. Markets are resilient. But resilience should not be confused with indifference. Every added layer of uncertainty raises the cost of capital. Every unresolved question delays investment. And every delay compounds over time. The idea that markets will simply ignores the real friction introduced when policy volatility replaces policy consistency. Adjustments are not free. They come with opportunity costs measured in slower growth and missed innovation. None of this suggests that markets are fragile. On the contrary, they are functioning exactly as designed, processing information, repricing risk, and reallocating capital in response to new conditions. But the signal coming through the system is clear. Uncertainty has a cost. And over these recent weeks, that cost has become increasingly visible. Strong economies are built on confidence. Confidence that rules are understandable, durable, and grounded in long-term thinking. When that confidence erodes, even temporarily, markets notice, investors notice. And the adjustments we see today are not emotional reactions. They are rational responses to a policy environment that has become harder to model, harder to hedge, and harder to trust. That is why these weeks have been challenging, not because markets are failing, but because clarity is. Economic growth does not collapse overnight. It erodes quietly, decision by decision, signal by signal. And the greatest risk to growth is rarely recession itself. It is the slow withdrawal of confidence that precedes it. When trade policy becomes unpredictable, when tariffs shift the cost structure of entire industries without a clear long-term roadmap, businesses don't stop operating. They stop expanding. And that distinction matters more than headlines suggest. Growth depends on commitment. Companies commit capital years in advance to factories, research, logistics, talent. Those commitments require a stable framework. When trade barriers rise suddenly or unpredictably, they inject friction into that framework. Margins narrow, planning horizons shorten, and management teams are forced to prioritize defense over ambition. That is not how strong economies compound over time. The impact is rarely isolated. A tariff imposed in one sector ripples outward through suppliers, distributors, exporters, and ultimately consumers. Costs move higher, but more importantly, uncertainty multiplies. Executives begin to ask harder questions. Will this policy remain in place? Will it expand? Will it reverse? And when those questions lack answers, capital waits on the sidelines. Delayed investment is invisible in the short term, but devastating in the long term. Markets can absorb higher costs. What they struggle to absorb is the inability to forecast them. When future cash flows become harder to estimate, valuation models adjust downward. Risk premiums rise. Financing becomes more expensive. That directly affects growth, not theoretically, but mechanically. Fewer projects clear the hurdle rate. Fewer ideas receive funding. Innovation slows, not because creativity disappears, but because uncertainty taxes it. This is where economic growth quietly loses momentum, not in dramatic sell-offs, but in boardrooms where expansion plans are postponed, in hiring decisions that shift from growth to maintenance, in research budgets that tighten because visibility narrows. Multiply that across the economy, and the result is a slower trajectory. One that may not register immediately, but compounds over years. Trade policy is often framed as leverage, but leverage cuts both ways. When tariffs disrupt global supply chains, they reduce efficiency. And efficiency is the backbone of modern economic growth. Global trade networks were built to optimize cost, speed, and reliability. Disrupting them doesn't just raise prices, it lowers productivity. And productivity is the single most important driver of long-term growth. The real danger is not short-term discomfort. The real danger is normalizing uncertainty. When businesses begin to assume instability as the baseline, they recalibrate permanently. Growth targets become conservative. Risk-taking declines. The economy adapts, but to a lower ceiling. Strong growth requires more than demand. It requires trust in the system. Trust that rules will not change abruptly. Trust that long-term investments will not be undermined by sudden policy shifts. When that trust weakens, growth doesn't vanish, it underperforms. And underperformance sustained over time is the most expensive outcome of all. Economic growth is built patiently and lost quietly, and the signals we send today shape the trajectory we live with tomorrow. Costs don't rise in isolation. They travel. They move through the economy quietly, systematically, and with far more persistence than most people realize. When tariffs are introduced, they don't simply appear as a line item on a customs form. They embed themselves into supply chains, pricing models, and ultimately into the daily lives of consumers and businesses. And once embedded, they are difficult to unwind. For businesses, the first impact is margin pressure. Inputs become more expensive, sourcing options narrow, and flexibility disappears. Companies are then faced with a choice that is never ideal: absorb the cost and accept lower profitability or pass it along. Absorbing it weakens balance sheets and limits reinvestment. Passing it along risks demand. Neither option is neutral and both carry long-term consequences. Small and mid-sized businesses feel this pressure most acutely. They lack the scale to renegotiate contracts or rapidly restructure supply chains. For them, higher input costs translate directly into tighter cash flow. Expansion plans are delayed. Hiring slows. Investment in technology and efficiency is postponed, not because ambition is lacking, but because resilience takes priority over growth. Consumers, meanwhile, experience tariffs not as policy, but as price. Higher costs show up gradually, a few dollars more here, a little less value there. Over time, purchasing power erodes. When households spend more on essentials, they spend less elsewhere. That shift dampens demand across sectors that rely on discretionary spending. Again, the effect is not dramatic in any single moment, but cumulative and persistent. Inflation dynamics become more complex in this environment. Cost push pressures distort pricing signals and complicate monetary policy responses. Central banks are forced to differentiate between demand-driven inflation and policy-driven price increases. That distinction matters because misreading it can lead to tighter financial conditions at precisely the wrong moment, further restraining growth. What makes cost pressures particularly challenging is their asymmetry. Prices tend to rise quickly, but they fall slowly. Once consumers adjust to higher prices, businesses are reluctant to reverse them, especially if uncertainty remains. This creates a ratchet effect. Costs move up, expectations adjust, and the economy resets at a higher price level. Businesses respond rationally. They seek efficiency, automation, and cost controls. But those adjustments take time and capital. In the interim, uncertainty persists. Investment decisions are filtered through a more cautious lens. Risk tolerance declines, and the economy operates below its potential. The narrative often frames tariffs as a tool to protect domestic interests. But protection comes at a price. When costs rise broadly, competitiveness suffers. Domestic producers face higher input prices, making them less competitive globally. That weakens export potential and offsets any perceived advantage. The real challenge is that these pressures are not temporary shocks. They become structural if policy uncertainty lingers. Costs harden into the system. Planning becomes reactive. And economic momentum slows not because demand disappears, but because efficiency is compromised. Strong economies are built on productivity, affordability, and confidence. When costs rise without clarity, all three are weakened. And while markets adapt, adaptation is not the same as progress. The difference between the two defines whether an economy merely survives or truly grows. Confidence is the most underappreciated asset in global markets. It doesn't show up on balance sheets. It can't be quantified precisely. And yet when it weakens, the effects are immediate and far-reaching. Global trade runs not just on contracts and currencies, but on trust. Trust that rules are consistent, that agreements will be honored, and that the framework governing commerce will not shift without warning. When that trust is shaken, markets respond long before data confirms the damage. Trade policy uncertainty reverberates far beyond borders. Capital today is global, supply chains are international, and investment decisions are interconnected across continents. When the world's largest economy sends mixed signals on trade, those signals echo everywhere. Partners hesitate, countermeasures emerge, alliances strain, and what begins as a domestic policy discussion quickly becomes a global confidence issue. Markets are forward, looking by design. They don't wait for disruption to arrive, they price the risk of it. When trade policy appears volatile, investors demand a higher return for taking risk. That adjustment raises borrowing costs, depresses valuations, and reduces liquidity. None of this requires panic. It happens quietly, rationally, and efficiently, and that's precisely what makes it powerful. For global businesses, uncertainty complicates every layer of decision-making. Supply chains optimized for decades are suddenly questioned. Long-term contracts feel less secure. Currency exposure becomes harder to hedge. Executives are forced to plan for multiple scenarios, none of which feel stable. That complexity drains focus and capital away from innovation and growth toward contingency and defense. International confidence is not just about economics, it's about credibility. When policy appears unpredictable, global partners begin to reassess assumptions. They diversify exposure. They seek alternatives. Over time, this fragmentation weakens the efficiency that global trade depends on. Redundancy replaces optimization. Cost replaces speed. And the global system becomes less productive as a result. Financial markets register this shift quickly. Volatility increases not because fundamentals collapse, but because confidence erodes, correlations change. Safe haven flows intensify, risk appetite narrows. These are signals, not overreactions. They reflect a market recalibrating to a world where policy clarity has diminished. The longer uncertainty persists, the more structural the consequences become. Temporary hesitation turns into permanent caution. Capital that once flowed freely becomes selective. Emerging opportunities are passed over in favor of stability. Growth potential narrows not because ideas disappear, but because confidence no longer supports them. Strong global markets require more than capital and innovation. They require predictability. They require a shared understanding of the rules of engagement. When that understanding weakens, trust frays, and trust is extraordinarily difficult to rebuild once lost. The cost of diminished confidence is not measured in days or weeks. It's measured in lost momentum, reduced cooperation, and a global system that functions, but below its potential. Markets adapt as they always do. But adaptation under uncertainty is defensive, not expansive. And the difference between a growing global economy and a cautious one is confidence. When that falters, the world doesn't stop trading. It simply trades with less ambition, less efficiency, and far less conviction. Short-term disruption is often defended as the price of long-term gain. The argument is familiar: endure the turbulence now to secure a stronger position later. But markets are disciplined judges of that promise. They don't evaluate intentions. They evaluate outcomes, incentives, and credibility. When disruption persists without a clearly articulated endgame, it stops being strategic and starts becoming structural. Every long-term strategy requires a roadmap. Businesses can endure volatility if they understand its purpose and its duration. What challenges markets is not pain, but ambiguity. When tariffs are introduced without a transparent framework for resolution or success, they create friction without direction. Companies are left navigating uncertainty rather than executing strategy. In theory, short-term trade barriers are meant to reshape behavior. In practice, they often reshape expectations instead. Management teams recalibrate assumptions about stability, access, and cost. Once those assumptions change, behavior changes with them. Investment horizons shorten, risk tolerance declines, and capital becomes defensive. The promise of long-term benefit hinges on credibility. Markets ask a simple question: what is the measurable objective, and how will we know when it's achieved? Without clear metrics, disruption loses its strategic narrative. It becomes noise, and markets are remarkably efficient at tuning out noise by reducing exposure. Strategic planning depends on consistency. Large-scale investments, infrastructure, manufacturing, innovation are irreversible decisions. They require confidence that the rules governing returns will not change unpredictably. When policy appears fluid, even well-capitalized firms hesitate. That hesitation is rational, and when multiplied across the economy, it becomes a drag on progress. There is also a timing mismatch. The costs of disruption are immediate and concentrated. The benefits, if they materialize, are delayed and diffuse. Markets discount the future, particularly when uncertainty clouds the path forward. That dynamic weakens the argument that near-term pain will necessarily translate into long-term gain. History shows that long-term economic strength is built through stable institutions, predictable policy, and open competition. Strategic advantages emerge from productivity, innovation, and scale, not from persistent uncertainty. When disruption undermines those foundations, it risks compromising the very outcomes it seeks to achieve. Markets are not opposed to change. They are opposed to incoherence. Clear objectives, consistent execution, and credible timelines allow investors and businesses to align with strategy. Without those elements, disruption erodes trust rather than building resilience. The danger is not that short-term pain exists. The danger is that it becomes normalized. Once businesses adapt to uncertainty as a permanent feature, they lower expectations. Growth becomes conservative. Opportunity costs accumulate quietly in the background. Long-term strategy is not measured by how much volatility an economy can absorb, but by how effectively it converts disruption into durable advantage. Without clarity, disruption remains just that, disruption. And markets, always forward-looking, will continue to ask the same question, not whether pain exists, but whether it serves a purpose.